Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. Welcome to the Create More Value podcast. This episode will be a bit different than the ones we have done before. I will not have a guest today, but instead will share some very important insights developed by Fortuna Advisors that can help you and your organization to create more value. I gave a talk recently using a TED-style talk, which was very new to me. I spoke about debunking relative TSR for LTIPs, which are long-term incentive plans. My talk was at the World at Work Total Rewards 24 conference in Cincinnati, Ohio on May 22nd, 2024. It was a great conference. I encourage those listening that have anything to do with Total Rewards to purchase the on-demand package to listen to all the talks and/or attend next year's conference in Orlando. I will leave info in the episode description below. Relative TSR is one of the most common metrics used in executive compensation, and our research shows it has flaws that make it much less desirable than you might think. What follows is an audio recording of my talk. So let me start by talking about the big picture. All incentive plans should be structured deliberately to motivate the kind of behavior that you want. Oftentimes when I speak to people and I say that, they look at me like I have four heads, like, of course, Greg, of course we design incentive plans to achieve desired behaviors. And frankly, I just don't believe them. I've just seen plans that encourage terrible behavior up and down all different industries, all different companies. And it's hard. You have to really think about it. So what I'm going to do at the beginning of this talk is I'm going to talk you through some types of bad behaviors that incentives that we commonly see motivate. And then I'm going to bring it down very specifically to performance share unit tests in long-term incentive plans and specifically relative TSR. And hopefully when I explain the research I did on why relative TSR is not a very good measure, hopefully, it'll resonate with you. So before I get into maybe more common problems that we have, let me talk about a spectacular recent problem that happened at a company. You may have read about it. Chemours put their CEO, their CFO, and a few other people on leave earlier this year because of some things they did around the end of the year. It seems that they stopped paying vendors in the fourth quarter and deferred payments until January. They pushed their customers to pay them in the fourth quarter payments that weren't due until January. And this artificially boosted their free cash flow, which was a measure used in their incentive compensation plan. Now, it was a bad enough situation that they got rid of the CEO, the CFO, and some other people, which obviously is very extreme. But I assure you, in small ways, things like that are happening in every company around the country. People do things at the end of the year to try to maximize their pay, and those are bad behaviors. They're bad behaviors because of two things. One, they're counterproductive. Like sometimes to get a client to pay you sooner, you have to give them a discount, and you're just giving money away for no reason if you had waited. And they're also counterproductive because of all the time that people spend trying to figure out how to game the system, how to cover their tracks, and everything else. So these tend to be really bad things. Next topic I'm going to go to is to tell you about one of my very favorite people that has ever walked this earth. And unfortunately, last month he passed away. But there was a Professor Michael Jensen, who was originally at University of Rochester, and then he was at Harvard. And two things about him that I want to point out that are relevant to this talk. First is he spent a lot of time talking about something called agency cost. And if you don't know what agency cost is, it's the cost to the company of the misalignment between the interests of management and the interests of the owners. And so if you motivate management to do this, but it's that's good for shareholders, then there's a cost to that. The shareholders suffer because the behavior is not exactly what would have been ideal. And the second point I want to bring up about Professor Jensen is in 1990, he and a Professor Murphy wrote a Harvard Business Review piece called CEO Incentives. It's not how much you pay that matters, it's how you pay.
You're saying the words as I said them. That's pretty cool. That's pretty cool. One of the best articles I've ever read in my life. If you get a chance, read it. If you don't have it, I can send it to you. Just email me. Even if you don't get time to read it, just remember the title. Because everybody gets fussed about how much we pay, but it's actually how we pay that matters. What are the things the person needs to do to earn another dollar? And are those the behaviors that you want? I often bring this up in meetings. And again, people look at me like I have four heads. Like they're not thinking about that at all. What do? They think about what are all our peers doing and how do we have a plan that's somewhere in the middle of them so we can't be criticized because we're doing what everybody else is doing, which of course is what perpetuates, all the bad incentives. But when I bring up this Professor Michael Jensen story with senior executives, their reaction is often, well, Greg, we're going to do the right thing no matter how you pay us. We just want to make sure we get paid fairly, but we're going to do the right thing. We're good people. And I just wish it were so. Now, some of the bad behaviors are subconscious. It's not like they're always deliberately saying, oh, I'm going to game the system, like the Camorra situation that we talked about a minute ago. But very often, even subconsciously, they do things that they just see as, well, that's how you play the game kind of thing. And they're counterproductive things, that are not good for the company. So that's an important thing. So let me give you a more common example than the Camorra's example of a bad behavior that an incentive plan encourages. And it was many years ago, over 20 years ago, I was working overseas with a client, and it was a retailer, and they had a number of different business units. And when the year ended, we were just starting to work with the company on what would have been the incentives that start a year later. And we were in their offices when the first filings of results came from all the businesses. And one of their businesses just hit it out of the park. It was unbelievable. Revenue, operating income, everything was higher than was expected. And everybody was really happy because the day before they got the financials from one of the other business units and they had underperformed. And so the people at corporate now felt, oh, wow, yeah, we're going to get a decent bonus now because this one business unit made up for the other business unit. It's all going to be okay, parties, celebrating and everything. And 2 or 3 weeks went by and all the parties stopped, because the business unit submitted their final numbers after going through an internal accounting review and so forth, and the operating income came down significantly. They had to take provisions for, loan loss provisions, bad debt provisions, inventory shrinkage provisions, warranty provisions, anything they could think of, to be honest. And I was skeptical, as I often am in such situations. I said, well, maybe, their story about all these provisions was true and they really needed to write down the profits, or maybe there was something else. So I looked at their incentive plan for that business unit, and the original income number was way above what would have given them the maximum bonus, the cap. And after they took all these provisions, it was right at that cap. Literally, it was like $1 more than what they needed to get the maximum bonus. And so what they were doing, I think consciously, was reducing profit this year so they could release those reserves and recognize the profit next year, because they're not getting paid for that extra profit this year. And next year it'll pad the bonus and they'll look pretty good. A lot of effort had to go into this, a lot of figuring out how far can we push this reserve and that reserve. The accounting department, which should be doing a close at that point in time, is working crazy on trying to manipulate the system. And this was all because of the way their incentive plan worked. It encouraged this bad behavior. And I assure you, unlike the Camorra's example, that example at that kind of level of detail happens in every company. Every single year, that kind of thing is happening in every company. And it's just crazy. So what I'm going to do now is I'm going to shift my focus a little, and I'm going to focus not broadly on all incentives, but I'm now going to focus specifically on long-term incentive plans, and in particular, performance share unit plans and the relative TSR tests that go along with them. And that's what I'll talk about for the rest of the time. And then I'll wrap up early so that there'll be some time for Q&A. They say that if you're camping in the woods and a bear shows up, you don't have to be able to run faster than the bear. You just have to be able to run faster than the other campers, right? If you run fast, you live. If you don't run fast, you die. Well, relative TSR works the same way. The people don't die. Their comp dies. But anyway, relative TSR, you probably all know how this works, but just for anybody who doesn't know, TSR stands for total shareholder return, And it's the return you deliver to your shareholders based on the share price movements up or down and dividends that you might pay as an annualized return on the beginning share price. So sometimes it's a cumulative return, but usually it's annualized. So that's TSR. Relative TSR is comparing that to the TSR of other companies. It might be the whole S&P 500 index, or some Russell 2000 index, or it might be the companies in your industry or your sector. Companies have a lot of freedom in picking who they want to be benchmarked against. And relative TSR is a percentile ranking against whatever that benchmark group is. So the company with the highest TSR is 100 percentile, the worst one is 0, and everybody else is kind of scattered in between. So we have TSR and we have relative TSR. And then the way these performance tests work varies a lot by company. But one common way it's done, and it's the way I did the research that I'm going to explain in a couple of minutes, is if you're in the top quartile on relative TSR, the 75th percentile or higher, you often get double what was a contingent grant of shares that you got at the beginning of a 3-year cycle. So that you're given, say, 10,000 contingent shares. At the end of the cycle, based on the performance test, you're either going to get more shares or less shares, usually capped at 200%, sometimes higher, and a floor of 0. If you're in the top quartile in relative TSR, usually you get 2 times 200% of the original contingent shares. So if you were given 10,000, you now get 20,000. If you're between 50th percentile, the median, and 75th percentile, it varies between 100% vesting and 200% vesting. Between the 25th percentile and the 50th percentile, it varies from 50 to 100% vesting. And if you're in the bottom quartile, you get 0. Lots of variations across companies, but that's kind of a common way that I've seen it done. So that's the way I structured my tests. Okay. And my research, by the way, was published in Workspan in 2018 in an article called The Relative TSR Conundrum. This is, I think, the 3rd event I'm speaking about this research. And the tests I did were very, very comprehensive. I took all the companies in the Russell 1000 that were public for the last 12 years before I did the study. Why 12 years? There's 10 3-year cycles in given 12 years of data. And so the first test I did showed that relative TSR doesn't actually align with shareholder value very well. I know that sounds crazy. It's got TSR in the title. How could it not align with shareholder value? But let me give you an example. NVIDIA, over that 12-year period, produced 1,700% total shareholder return. By the way, this is before artificial intelligence. We should have all 20 years ago sold everything we had and just bought NVIDIA stock. That would have been the thing to do. We'd all be talking about this on our private island now. 98th percentile across the portfolio. So, of course, they must have vested in a lot of shares, right? Because they had such great performance. But when you looked at the 10 separate 3-year cycles and you calculated the relative TSR against the whole market for each one of those cycles and averaged them, their average percentile ranking was only 44 percentile. They only would have vested on average in 79% of the shares. They produced 1,700% return over 12 years, and they would have gotten less than the original grant on average of shares, because sometimes they did unbelievably well and sometimes they did unbelievably bad. And when you average that all together, with all the quirks of the caps and the floors, if you're 76th percentile, you're 99th percentile, you get treated the same. As soon as you get to 24th percentile, you lose everything. So it all works in kind of a funny way. And when I looked at that, I said, wow, that's crazy. But then what was even worse was I looked at the whole sample of over 700 companies, and about half of them meaningfully overpaid people relative to long-term performance, and about half of them meaningfully underpaid. If you took the average difference between what they would have earned over 12 years if it was all one cycle and the average of the 10 cycles, the average difference was 45% of the PSUs, which is a massive distortion between what they delivered to the shareholders and what the management got. In the companies where the management got way less than what the shareholders got, that's a retention problem, right? They're going to feel frustrated and so forth. And the other way around, it's an investor relations problem when management's making a lot of money and the share price isn't doing that well over the long term. And so it's very poorly aligned with long-term TSR. But that's actually not the bad problem. It's a bad problem, but it's not the worst problem. The worst problem is actually how fickle and volatile and lottery-like relative TSR is. And to test that, what I did was I took the last 4 years, and now we had over 900 companies that were in the sample because over 900 companies were public for that period of time. And I ran 52 different tests, one as of the first week of the final year of that period of time, one a week later, 1 week later. So I reran the whole performance test for every company over 52 different periods, that each separated by 1 week. And let me just tell you an example. Celgene was a good example. The first cycle of the year, they would have vested in 148% of their shares. Over the next couple of weeks, it dropped to 122. By mid-April, it would have been 200%. It would have stayed at 200% for 8 weeks. And then it started to decline steadily. And by the last 4 weeks of the year, they would have gotten nothing. They would have lost all their shares. So this supposedly long-term incentive plan is unbelievably volatile. There were quite a few companies that would have been at 0 or 200% vesting, depending on what point in the year you did the test. And I don't know, my clients always complain that we seem to always do the test when we get nothing, not when we get 200%. But that volatility makes people devalue the equity that you give them because they can't count on it. It's so fickle. It's like a lottery. And that means you're like charging the shareholders $1 for something that the executive only views as being worth maybe a quarter or a dime or something like that. I've seen people deliberately do things to get $1 of bonus that cost them $5 of their LTIP, but the annual bonus just seems like something more in their control, so they'll make that trade-off. That's not a well-designed LTIP if that's the kind of trade-off that people are making. So let me just talk briefly about 2 examples we've done where we've gotten away from relative TSR mostly, and then I'll open it up to questions. One is a company called Varian Medical Systems, which is now part of Siemens Healthineers, but it was the largest producer of radiation therapy equipment for the treatment of cancer. So great company. By the way, while we worked with them, they dramatically increased their R&D. They launched proton therapy, and so it was a really good, good story. We convinced them of these problems of relative TSR, and we got the comp committee to approve a completely different approach. It was a 5x5 grid, where on one axis was revenue growth, and on the other axis was the change in the EBIT margin from the beginning of the 3-year period. And what made it special, that's not that special, but what made it special was we didn't negotiate any of the parameters of the grid. We studied the market. We determined 56 business model peers, which are not just competitors, but companies that have similar business models, statistically determined. And then we set the parameters of the grid based on what those companies had done over the prior 15 years. So top 20%, next 20%, that's a 5x5 grid. It all came from the experience of companies. No negotiation, no long debates about plans or anything like that. And what we did was we back tested it with over 5,000 data points. What would have happened over any 3-year period, which we only rolled 1 quarter at a time in this study. What would have happened? What would your TSR have been when you were in this box or this box or this box? And we looked at all those observations across these 25 boxes. And almost always, when you increase growth or you increase your margin, the TSR was higher. It worked out really perfect. So we're able to convince the comp committee that if management focuses on trying to make more money using this grid, they're going to drive TSR, but without all the fickle volatility and so forth that you get with relative TSR. And so their proxy really explained it in a lot of detail, more than I'm going into now, which was really good because it was a very big change for them. The comp advisor, the comp committee's outside advisor, made a suggestion at the meeting of why don't we just put a filter in that says if they're in the bottom quartile, they can't get more than 1x, bottom quartile on relative TSR. So you want to add a little bit of relative TSR back in. And one of my great moments, every once in a while you get something really right. One of my great moments was that meeting because I immediately said, well, if we're going to have a cap in the bottom quartile, let's have a floor in the top quartile. When you're in the top quartile on relative TSR, you can't get less than 1x. And then, so that was one example of a system that hardly relied on relative TSR. And one other one I'll tell you about, just to give you a little bit of variety, because there isn't really usually one solution to these problems, was a company called Elanco Animal Health. And Elanco's system uses a measure called EBITDA. You've heard of EBITDA? Well, we add back the R&D. And then the target for EBITDA in any period, any year, is last year's EBITDA plus however much they invest multiplied by, I think it's 9%. And so if they invest more, their EBITDA target automatically goes up. And if they invest less or they sell an asset, their EBITDA target can even go down. But it's all very determined by their actions. And so every time somebody says, well, let's invest another $100 million, they're thinking, where are we going to get the $9 million of income? So it's causing them to really think about returns and so forth. And again, we were able to show the comp committee that this plan, the measure, simulated, back tested for a lot of companies, actually correlated really, the payouts really correlated really, or the vesting really correlated well with TSR, which was, very, very important to them. So with that, I'm going to stop there and see if there are any questions. Hopefully that was helpful.
I follow your logic for debunking it. Is there no kind of one size fits all solution for okay, if not that, then X? Or is it just really based on your company's growth? Like what constitutes growth for you?
I think there are a number of better solutions. I think it's important to use measures people can get their hands around. Not that you can control your revenue growth, for example, but you feel it's more of an influenceable thing than your share price, which, in 2008 suddenly just dropped and through no fault of your own. So I think fundamental measures is a good way to go. I think trying to structure it in such a way that it encourages thoughtful behavior. That's why we did growth and margin, right? So that there's a trade-off between we want growth, but we also want profit margin. You can give up a little margin to get growth as long as you get enough growth. We illustrated all that for the management. I think once you come up with something that logically makes sense, I think doing back tests of how would it have paid for a series of related companies, extensively looking at trying to find, are there situations where it would have paid way more than it should have or way less than it should have? And can we do something, change the measure or do something to try and avoid that? I mean, with Varian, we wanted to use return on capital and we just couldn't get it to work as well. And so we used profit margin. I think it's, the basic answer is, it can vary, but it varies based on what really works the best for a company and its industry. That's been my experience. Anything else? All right. Well, thank you all very much. Appreciate you coming.
You have been listening to me, Greg Milano, speaking at the World at Work Total Rewards 24 conference in May 2024. If you have questions about how this applies to your organization, please contact us at info@fortuna-advisors.com. You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.